at Dolat Capital, is with us now. Amit, good afternoon. Good to have you on the show. So first things first, it's been a couple of days of a bit of a scare for the bulls because we came in at that 20 DMA level, and that's where the index seems to have taken support, at least for now. We also saw one or 2 days where the mid-cap index started cooling off quite significantly, though things have come back with a bang. What's your sense, and what's the overall market advice right now? Are you advising profit booking, say, on mid-caps, small caps, or are you using every dip to buy?
Well, thanks, Surabhi. I think there are two, you could judge it to both ways, essentially. What we've seen is that the market has taken a big leap of faith over the last few weeks in terms of valuations realigning and re-rating in a lot of stocks and a lot of sectors, so to say. So our sense is that the first part of this up move is largely getting captured now, and therefore it may make make sense to take some money off the table, at least from the large cap perspective. Now, to your point specifically on mid-cap and small caps, I think we believe that there is significant tailwinds which are going to operate over the next 2 to 3 quarters. At least that's the visibility we have, wherein there is a pretty high level of conviction, which will help a further re-rating and possibly earnings sustainability to be much better. So I would probably still stay invested in mid and small, but large caps in particular, especially the index stocks, maybe makes sense to take some money off the table because those are liquid names, and dips can always be used to add the position, which is our current recommendation as well.
Amit, earlier today we were chatting with Centrum Broking and we were asking them that what have your ground checks thrown up in terms of a demand environment over the last 2 months to gauge how Q1 has shaped up for the corporates, and they said that the retail demand, the rural demand has been quite weak. They were anticipating things would improve, but it hasn't in the month of April and June, and they were quite negatively surprised by the demand when it comes to from consumers, the retailers, particularly on the rural side and across segments, footwear, apparels, etc. Can you tell us what your ground checks have thrown up sectorally? What stands out for you in terms of big themes based on your interactions with corporates?
Well, I would say it's not materially different, but I think our take is slightly from a different perspective. When we are recommending domestic consumption as our preferred theme for the next 12 to 18 months, it's partly at this stage driven by the raw material inflation getting normalized to a very large extent, and that becoming a tailwind to the operating margins. If you look at the last 12 months, ever since the Russia-Ukraine war started, we saw a significant inflation on key inputs, going through the roof. That took its own time to resolve. And as we go along now, and it's evidenced in the data, WPI is now in the negative territory. Inflation in India has largely cooled off, and so has global inflation cooled off. To specific point of demand, I would say we have not seen a very significant change in the demand patterns. But our expectation is that as the inflationary expectations get more muted in the minds of the consumers, they will come out to sort of start spending, on domestic consumption categories in particular. So I take your point that at this stage there is little evidence to show that the demand has turned around very significantly. But we also believe that the first 2 quarters of this fiscal year, which we are currently in, will largely be driven by the operating leverage on lower raw material costs for the companies. And hopefully by that time, we will see the consumers coming back to spend money, and then the top line growth will eventually start showing in volumes as well.
Okay, got that. By the way, there was some important news at the bottom of your screen as well. The SAT has stayed the SEBI order on IIFL SEC. Remember I think last week this news came out, right, where SEBI said that for 2 years, IIFL Securities will not be able to onboard any new clients. The stock had, of course, seen a big slip. Right now, it's up around 5.5% after this new order came through. But that is on IIFL Securities. Amit, I remember, speaking with you a while back, and you did mention that you do like some of the IT stocks at that point, some of the larger IT names. Is that still a view that you hold? And, where within the IT space do you now see value?
Well, we preferred large caps in IT versus mid cap and small cap because the valuation differentials were more favorable as we see. But from a sector stand, we've been neutral. But previously our stance was more negative to neutral. We are now not as negative. primarily based on the situation that the deterioration of data point that we were expecting from the US has not been as bad. And therefore, you could very likely see FY24 getting through with 5% 6% earnings growth, which has been our base case versus the market, which was at 7 to 8% earlier, but eventually got realigned to 5 to 6% odd numbers. Our extreme case was that will we see a risk of a 0 to 3% earnings growth, which is essentially zero growth, so to say. I think that that probability has gone down, and therefore we are less negative. To play the pack, obviously our preferred picks remain on the large cap, which is HCL Tech and Tech Mahindra in that order.
They are the relatively cheaper ones in the tier 1 IT companies. Amit, thank you very much for joining in. Get into a break. We'll come back with more on the market.